Hello students, beginning with unit number 4, investment decisions. Today we will be seeing only investment decision theory part, that is today we will be seeing capital budgeting theory. First let me tell you all what all is covered under the unit or module 4, that is investment decisions. It covers capital budgeting, which is only theory for the below points: meaning of capital budgeting process, capital rationing, risk analysis in capital budgeting, and capital budgeting techniques. Capital budgeting techniques is also called as investment evaluation techniques. This is theory part, and this is all the parts relating to problems. So under investment evaluation techniques, you have payback period, discounted payback period, accounting rate of return, net present value, internal rate of return, modified internal rate of return, profitability index, and case study on replacement of capital project. Today in this video lecture, we will be covering only this part, which covers only theory. So we'll be seeing what is the meaning of capital budgeting, what is capital budgeting process, what is capital rationing, what is risk analysis in capital budgeting, and capital budgeting techniques. Which are the capital budgeting techniques? Problems we'll see later. So I've named this module as module 4.1, which is module 4 part 1. So moving ahead, what is the meaning of capital budgeting? So first we'll read out this. Capital budgeting is the process a firm undertakes to evaluate potential major projects or investments. Capital budgeting is a process of evaluating investments and huge expenses in order to obtain the best returns on investment. It is required in order to know whether a particular investment has to be approved or rejected. So in short, what does capital budgeting means? Capital budgeting is nothing but it is making an investment decision. Investment decision of a firm is generally known as capital budgeting or capital expenditure decisions. Many a times firm wants to invest in a new project. Maybe it is planning for an expansion, acquisition, replacement of a long-term asset. So when it is making a huge long expenditures or when it is planning to make a huge heavy investments, it cannot directly make without making an analysis whether such investment or such expansion will be profitable to it or no. So taking such investment decisions is nothing but capital budgeting. A capital budgeting may also be defined as maybe the firm's decision to invest its current funds most effectively in the long-term assets in such an anticipation that that long-term asset will give some flow of benefits over a series of years. As you already know, what is a long-term asset is those that affect the firm's operation beyond a period of 1 year. So capital budgeting is nothing but it is a process of taking a decision whether to invest or not, whether to go for expansion or not, whether to expand, whether to get in a new product in the firm or not, whether to replace the long term assets or not. So it is all capital budgeting is nothing but taking a decision, and the decision is based on what is the profit the or what is the inflow that the firm or a company will be getting for the investments it is going to make. And the firm's investment decisions would, like here it is the investment decisions. So the firm investment decisions could be either, as I already told you all, either it could include expansion, acquiring something, modernization, or replacement of the long term assets. So in short, in this image you can see that capital budgeting is the firm, this is Peter, but you can assume it as the firm, whether the firm should invest in the project if the project cost is going to be $10 million. So the firm has to think whether by investing in this project it is going to be beneficial to the firm or such investment is going to be profitable to the firm. Such decision process to be taken is termed as capital budgeting. Next, let us know what is the capital budgeting process. Like when taking an investment decision, what is the process that is required to be followed? So the capital budgeting process is as follows. First, identifying the investment opportunities. Second, evaluating the investment proposals. Third, choosing a profitable investment. Fourth, capital budgeting and appropriation apportionment. And third and fifth is performance review. So let me elaborate more on first point, identifying investment opportunities. See, first of all, every organization has to first see what are the different investment opportunities that are available to a particular firm. And that investment opportunities can be nothing but, as I already told you in my previous slide, that it can be either some expansion, acquisition, modernization of its business, or replacing some old long-term asset. So it has to identify the different opportunities available to it. Second is evaluating the investment proposals. Once the company or a firm knows what are the different opportunities available, it has got to recognize an organization's need to evaluate its option for investment. It has to evaluate which investment opportunities that are available will meet the need of the organization. So whether the company wants to decide on adding a new product line, or should it go for it, should it not go for it, whether it will be beneficial. So it has to evaluate each investment opportunities that is available based on one. Third, choosing an profitability investment. So after doing the second step, the company or a firm has to choose a profitable investment. When I say profitability investments means once the investment opportunities are identified by the firm and all first step identified all the investment opportunities. Second, it has evaluated according to the needs of the organization. It is most important is the third point to decide whether that particular investment will be profitable to the organization or not. So while selecting which is going to be the most profitable investment among the different alternatives available, it has to use the techniques of capital budgeting, which we will be seeing in the later slides. It has to use those techniques of capital budgeting as well as capital rationing in order to rank the investments. So once you rank the investments that opportunities that are getting the first rank will be the best option that will be available because it will be having the maximum returns. So choosing the profitability investment and then capital budgeting and apportionment. Now once the company selects an particular investment, the organization needs to fund that particular project. So for funds, the company needs to identify the sources of fund and allocate it properly. See, once in step number 3, the company has selected a particular investment which, yes, is going to turn profitable. The company knows by using the techniques that, yes, this particular investment will fetch me maximum returns, will fetch me maximum benefit. Then what the company should do in the step number 4, that it should try funding that particular investment because every investment requires high amount of funding. So it should see the different sources and allocate it properly. The sources, as you all know, can be in the form of reserves or it can be in the form of, we have seen already in unit number 3, different sources of financing and loans or by any other source of finance. Next, last one is performance review. The last step in the process of capital budgeting is nothing but reviewing the investments. Initially, the organization had selected a particular investment for a predicted return. So now they will have to compare the investments from expected to the actual. Means based on some projected inflows, based on some projected returns, the company had chosen a investment for which in step number 4 it had funded. Now they have to review that investment in such a way that they have to compare what is the actual return they are getting with the expected returns, whether it is same, more, less. So performance review of all the investments should be made. So this is nothing but capital projecting process which starts from first identifying the investment opportunities available, then evaluating the investment proposals to the needs of the organization. Then among all these available, it has to choose an appropriate investment which gives the maximum profit. Fourth, it has to apportion funds and do capital budgeting. And fifth is it has to review whether the investment on in which they are going to fund or they are funded is meeting the expected returns. They have to do the comparison based on what is the actual return. So moving ahead, capital rationing. Now what is capital rationing? Let us see. Capital rationing is the act of placing restrictions on the amount of new investments or projects undertaken by a company. Rationing means putting restriction on the amount. Here, capital rationing is putting restrictions on the amount of new investments or projects undertaken by the company. When a company is required to operate within a limited budget with regard to a capital expenditure, it is termed as capital rationing. Means where, in other words, where the company is having a limited budget, and from that limited budget it has to make investments. Okay, so obviously we can see that capital rationing is a process of investing in profitability investments projects by placing restrictive limits on different factors. Since the budget is limited, then there will be limitations on other factors also while making the investment decisions. Thus, the company can select the best profitability project by ranking the projects. Since there is a limited budget, it has obviously got a restriction to make an investment. It will make an investment in that project which is more profitable by ranking the projects. So this is capital rationing, where they place restrictions on the amount that has to be invested in the new investments or projects. Next, risk analysis and capital budgeting. See, as you already know that there are lots of risk attached in any investment that is made by the company or a firm, because no investment can be risk free. So exception FDs, but still that also is fluctuating based on the rates. But this is capital budgeting where it will make a long-term investments either for expansion, acquisition, modernization, replacement of some old asset. So obviously some risk is involved in capital budgeting. So what are the methods which will help us in analyzing the risk in capital budgeting? So let us see, these are all the risk analysis and capital budgeting that are methods that will help us to analyze the risk in capital budgeting. First one is probability and expected values. So as you know that probability is highly useful tool for measuring any risk, because the probability of a specific result of an event is the number of times the outcome is likely to occur if the experiment is conducted large number of times. So either you can use this method in order to evaluate the risk. Second is standard deviation method. So standard deviation is nothing but the risk or uncertainty that is attached to a capital expenditure project can be calculated by using standard deviation, and you know standard deviation is nothing but the square root of the sum of the products of probability to each consequences and the square deviation of each consequences from the value of average outcome. So by using the method of standard deviation also you can analyze the risk. Next is optimistic and pessimistic estimates. See, this technique helps the company in taking stock of all possible outcomes of decision. Whatever are the decision, taking the outcome of all the decisions. So by this, it helps in making the right decision, keeping in view all the risk that is involved. So the analysis in the third thing can be, there can be either three estimates. The best possible appropriation can be made, or the worst possible appropriation can be made, or the most likely appropriation can be made. Next is risk adjusted discount rate. Now, risk adjusted rate of return, discount rate, we have already seen in unit number 2, time value of money, what is the discount rate. So the risk adjusted rate of return is also known as risk adjusted discount rate. So this method is nothing but a performance measure method under uncertainty. It can be modified in order to avoid the risk which is initially faced by the investors at the time of purchase of investments. So by using the discount rate and knowing what is the risk attached to the particular investments, the risk can be avoided. Next, certainty equivalent method. So under certainty equivalent method, this considers the expected cash flows instead of the discounted rate. Now here, usually what we do, we first fund a particular investment. So that is called initial cash outflow. But later we will be getting the inflows in the coming years. So certainty equivalent methods will not be considering the discount rate cash flows, it will be considering the expected cash flows. Like what is a certain or expected cash flows. So by this we can analyze the risk. Next is simulation method. So under simulation method, it is very simple method for evaluating the investment projects, and this method is used when the projects are highly uncertain in nature because there are various uncontrollable factors that that simply add on to the risk. That is the reason we can use simulation method, which will help us in finding the various uncontrollable factors that are attached to the probability distribution, and sampling can be carried out. And this method can be done by evaluating the probability distribution on different financial criteria. So the overall distribution is used for making the decision under simulation method. Next is decision tree approach. So here the technique is based on whether like to undertake a particular capital project or not, or to select among the best two alternatives capital project. So the application of the decision will be shown in the decision node in the form of a tree, whether among the different alternatives available, whether a particular alternative should be selected, whether a particular investment is selected. So what are the benefits attached to both the investment alternatives? So it is shown or depicted in the form of a decision node or a decision tree. Next is sensitivity analysis. So now this technique, sensitivity analysis, this technique will measure what is the change in the probability, okay, of a project due to changes in different factors that is affecting the cash flow of the project. Now the project which is highly sensitive or is considered to be more sensitive in factor, that means even if a minor change is happening, it will highly affect the probability of the project. So sensitive analysis means uh, focusing on the probability of a project due to the changes which will affect the cash inflows of a project. See, whenever a company is investing in a project, it will obviously invest with an intention of getting cash inflows in the coming years. So this sensitive analysis will focus on the probability where there are chances that some factors may affect the cash inflows of the project, and such factors may be very sensitive because if any change in that factor will highly affect the probability of the project. So these are different risk analysis in capital budgeting. These are the different methods which is going to help you analyze the risk in capital budgeting. Next, capital budgeting techniques. So now we'll just be seeing the theory part. In my next video lectures, we will be seeing the problems on different techniques. That is what is covered in the syllabus. So moving ahead to the first is capital budgeting or evaluation techniques is divided into two types. that is traditional technique or method, and modern technique or method. Now, under traditional method is also called as non-discounting cash flow technique, and modern method is also called as discounted cash flow technique. So, in unit number 4, investment decisions, you have problems only on these techniques. Rest all is theory. So, capital budgeting technique is nothing but also called as investment evaluation techniques, because with the help of these techniques, what we will be seeing, it will help you to decide whether to invest in a particular project or no. So it is divided into two types, traditional and modern. Traditional is also called as non-discounting, and modern is also called as discounted cash flow technique. So traditional method or technique is divided into two types again, payback period and accounting rate of return. And modern techniques is divided into four types, net present value, internal rate of return, modified internal rate of return, and profitability index. So I'll just be explaining the theory now. In detail, the problem for each of the techniques will be covered by me in the next video lectures. So first traditional method is the payback period. Now this is payback period is the most popular under the traditional method and most recognized under the traditional method. Now what is the meaning of payback? Means once you have made an initial investment in a particular project, once you have put the amount in a particular project, what are the number of years it will take in order for that project to pay back the returns to you, which is equal to your initial investment. Suppose you have invested 5 lakhs in a particular project. So what are the number of years in which the project will fetch you back 5 lakhs? So what are the number of years where the project will pay back the amount that you have invested to you? So payback is nothing but the number of years required to recover the original outlay invested in the project. So payback period is nothing but the number of years required to recover the original cash outlay invested in the project. Now suppose if the payback period is less, suppose the number of years required to recover your initial investment is less, obviously you can go for that particular project. Suppose if it is very long, you require a lot of number of years in order to recover your initial investment, then you have to think twice before investing in that particular project. Next is accounting rate of return. So in this accounting rate of return, it is also it is coming under the traditional method of capital budgeting technique, and it is also known as the rate of return on investment. Accounting rate of return is also known as return on investment, that is ROI. And under this method, it is going to use the accounting information, and obviously accounting information you will get in financial statements. So it is going to use the accounting information, okay, to know the profitability of an investment, and accordingly it is going to make the decision. So in case of accounting rate of return, the decision whether to invest in a particular project or not is going to be based on the accounting information, okay, which is revealed by the financial statements in order to measure what is the profitability of a particular investments. Next, coming to modern method or discounted cash flow techniques. Now, you know what is the meaning of discounted? That you know that the future cash flows will be discounted and brought to the present value. So, discounted is used when the future value has to be brought to the present value. That is when you use the discount rate. That is why it is called discounted cash flows. So, first one is the net present value. So, this is net present value is a very classic method for evaluating the investment proposals. In net present value, what you will do, you know what is your present value of the initial cash investment or initial cash outlay, because when you're investing the project, you obviously know what is the total amount that is going to be the cost to incur in that particular project. Now you know that you will expect some returns, cash inflows in a future years. So net present value will help in getting those future cash flows to the present value. So in net present value, you can evaluate whether a particular investment is opt or no by comparing the present value of cash inflows with the present value of cash outflows. So suppose the inflows, present value of inflows is more than the present value of outflows, then obviously you'll go for that particular project. Otherwise, you will reject that project, because suppose if the outflow is more and inflows you got is very less, and this both you're comparing by bringing them up to a present value. Both are you're bringing under a uniform platform under the present value. So if the present value of cash inflows is more than the outflows, then you will obviously go for that particular investment proposal. Otherwise, you will think twice before investing in that particular proposal. Next is internal rate of return. This is another discounted technique which will take into account the magnitude and timing of cash flows. So under internal rate of return, it will consider what is the magnitude and timing of the cash flows. So it will help to know the return or the yield on any investments and what is the efficiency of that capital or rate of return over the cost. So different factors are considered. The magnitude is considered under this method in order to evaluate the investment proposals. Next, modified internal rate of return. Modified internal rate of return is nothing but there may be some uh, faults in internal rate of return or uh, some deficiencies in internal rate of return where it has given birth to modified internal rate of return. So modified internal rate of return also is to measure the investment attractiveness, like which investment is more attractive, and it is nothing but a modification to the internal rate of return which aims to solve some problems here, some issues which couldn't be solved in internal rate of return. Here some additional factors are being considered. And the next part is the profitability index. Now under profitability index, you're going to evaluate the investment proposals again based on the cost benefit ratio. So here you are going to compare the present value of cash inflows at a particular rate of return with what? With the cash outflows. So in profitability index, you're going to compare the cost with the benefit and then see and take a decision whether that particular investment technique is going, whether the investment proposal is going to be beneficial or should be accepted by the company. So these are the different techniques. The advantages, there are advantages and disadvantages associated with different techniques which I have given in detail in my theory notes. So you can go through the theory notes, and we have completed with this module 4.1, that is the complete theory relating to capital budgeting. Here in this video lecture, I have just focused on the key points, but in detail, the theory is given, already shared to you all in the theory notes. You can go through it, and any difficulty, you can contact me. Thank you so much.